Bismillahirrahmanirrahim. Assalamu alaikum everyone. Today's our topic is macroeconomics and industry analysis. The fundamental analysis is that the intrinsic value comes from its earning perspective determined by the global economic environment, economic factor affecting the firm's industries and the position of the firm within its industries. The global economic, international economy affects from a prospectus performance in the country and the region can be highly variable. Harder for a business to succeed in the contracting economies than in expanding ones. Political risk, the Greek and Spanish economies, US fiscal collapse, exchange rate risk is the change the prices of import and export. It's a best example of that. Honda is manufacturing in the North America. Exchange rate changes. The change in the real exchange rate in the US dollar versus major currencies, or we can say the local currencies of your countries. The domestic macroeconomy, stock prices rise with earning PE, price to earning ratio, or a normal range, or the normal range is that lie between the 12 to 25. Forecasting the performance of a broad market beings with an assessment of the economy as whole. S&P 500 index versus earning per share. S&P stands for Standard and Poor's. 500 indexes versus earning per share. Uh, sorry. The domestic macroeconomies, the key variable of the domestic macroeconomies is gross domestic product. We can say that GDP, unemployment rate, inflation, interest rate, budget deficit, and sentiment. Demand and supply shock. What is demand shock? And even that affect the demand for a goods and services in the economy. And even that influence supply stock is an event that influences production capacity or production costs. Demand side policies. There are two demand side policies. This the first one is a fiscal policy and second one is a monetary policy. So what is a fiscal policy? The government spending and taxation actions is called fiscal policies. The monetary policy, manipulation of a money supply. Fiscal policy, most direct way to this stimulate or slow the economy. Formulation of fiscal policy is often a slow, cumbersome political process. Fiscal policies still continue. The net effect of a fiscal policy is budget surplus or deficit. The deficit stimulates the economy because spending increases demand for a goods, increase taxes, reduce the demand for a goods. Monetary policy, the money supply manipulation to influence economic activity. Increase the money supply, lowers interest rates, stimulate the economy, less immediate effects than a fiscal policy. Monetary policies still continue. The tool of the monetary policy is open market operation, discount rate, and reserve requirements. Supply side policies. Those were the demand side policies, and now we are talking about the supply side policies. Create an environment in which the worker and the owner, an environment in which the worker and owner of a capital have the maximum initiative and the mean to produce and develop a goal supply side that focus on how tax policy can improve initiatives to work and invest. Business cycle. The transaction point across the cycle are called peaks and through the peaks sorry, the transition from the end and the expansion of the start of a contraction. Through the occur at the bottom of recession, just as the economy entered and recovering. Business cyclical industries and defensive industries. Above the average sensitivity to the stage of the economy, the example is that the consumer durables and capital goods, they have a high betas. And the other side, there's defensive industries. It's a little sensitivity to the business cycle. For example, the food procedure and processors, pharmaceutical firms, and public utilities, it have low betas. Economical indicators. There are three economical indicators. The first one is leading indicator, coincident indicator, and lagging indicators. The index, acha, sorry. The leading indicators tend to rise and fall in advance of the economy. The coincident indicator mean that move with the market, and the lagging indicators mean the change they subsequent to the market movements. For example, here is a lot of example of leading indicators. Average weekly hour of production workers, manufacturing, to the initial claim and unemployment insurance, manufacturers, new order, consumer goods and material industries. Third one, Institute of Supply Management, index of a few order. Number five, the new order for the non-defensive capital goods. New private housing unit authorized by a local building permit. Economic indicators of the first, we are still discuss the leading indicator. Yield curve slope, 10-year treasury minus federal funds rate. Eight is the stock prices, 500 common stocks. Leading index of a credit market condition, index of a consumer expectation for a business condition. B. The coincidence indicator. The first example of coincident indicator is employees on a non-agriculture cultural payrolls. Second is the personal income less transfer payment than the industrial production, manufacturing and trade sales. Economic indicators is still continue. Now we are discuss the third indicator, that is a lagging indicator. Average duration of unemployment. These are the example of the leading indicator. Average duration of unemployment, ratio of trade investors to sale, change in index of a labor cost per unit output, average prime rate charged by the bank, commercial and industrial loan outstanding, ratio of consumers installment credit outstanding to the personal income, change in the consumer price in indexes. These are the graphs which show the leading coincident and leading indicators. This show the leading indicators. Now this is a this graph is showing the practically showing the coincident indicators. Now third one is a leading indicator. Industry analysis, similar to an aligned microeconomics. It's unusual for a firm in a troubled industry to the perform well. Economic performance can vary widely across industries. Return on equities. Here is the sectors. Sectors. I wait a minute. I screen that to you. So these are the sectors. We can say that just like we are divide the companies in a different sector, just like airlines, restaurant, pharmaceutical, toys and game, assets management, chemical production, cable TV, residential, data storage, telecom services, healthcare centers, grocery stores, tobacco products, auto manufacture, home improvement, application software, money central banks, water utilities, and integration or integrated of oil and gas. Industry stock price performance 2012 versus 2016. Here is both in both sides are here, positive and negatives. You can say in this picture, or we can say in this slide. Defining an industry, North America Industry Classification System or NASA's North American Industries Classification System codes. Firm with the same four-digit NASA's and NICE's code or a community take to be in the same industries. These are the codes, like just like a 23, the code of construction. 236 is the code of construction of business. 2361 is the code of residential building construction. 23611 residential building construction. 236115 is the new single family housing construction. A is like so on. These are the codes. Sensitivity to the business cycle. There are the three factors determine a firm sensitivity to the business cycle. The first is sensitivity of sell. Necessity versus discretionary goods. Items that are not sensitive to the income level, such as the tobacco and movies, versus the items that are such as a machine tools and steel autos. The second sensitivity to the business cycle is that operating leverage. Firm with the low operating leverage, that means less fixed assets are less sensitivity to the business condition. Firm with the high operating leverage, more fixed asset are more sensitivity to the business cycle. Sensitivity to the business cycle is still continue. Now we are discuss the third sensitivity to the business cycle is financial leverage. Interest is a fixed cost that increase the sensitivity of a profit to the business cycle. This is the example of the industrial cyclicity. Industry cyclicity, growth of sales year over year into industry. Sales of jewelry show much greater variation than sale of groceries. Operating leverage of a firm A and B throughout the business cycle. Just like here is the example of firm A and firm B. Firm A have a low fixed cost and firm B have a high fixed cost. So you can see that there is you can see, or we can say that you can compare that the firm A and firm B in the recession stage. Sale is $5, then then price per unit is a $2, both of companies A and B. Then revenue generate both are $10, $10 million. Fixed cost is 5 of company A and 8 of company B, firm B. Then the variable cost is the low or high of company firm A and low in firm B. Then the total cost is 10, and here the total cost of the resection in the firm B is 10.5. So the profit is 0.5 of company B. It's higher than company A, or we can say firm A. So you can again compare in a normal stage, and then you can again compare in a expansion stage. So here is the profit is same, $1 million. Then other expansion here the profit is a change. The firm A take a $2 million and firm B earn 2.5 take $2.5 million. A styles depiction of the business cycle. These are the stages of the business cycle: the peak, construction, through expansion, and again peak. Sector rotation. Portfolio is shifted into the indicators into the industries or a sector that should outperform according to the stage of the business cycle. Sector rotation. Peak, the natural resource extraction firm, the construction defensive industries such as the pharmaceutical and the food, through the capital goods industries in expansion, cyclical industries such as the consumer durable. Okay, this is the picture are of this cycle. So typical sector of rotation throughout the business is called that energy, healthcare, consumer strips, utility, financials, technology, consumer discretionary, material, industry, and energy. These are a recovery, boom, and recessions. Industry life cycle was industry life. We are now discuss industry life cycle. The first stage is startup, consolidation, maturity, and relative decline. The sales growth rapidly and increase, stable, slowing, and in the end, minimal, or we can say the negative. Take a look at this in picture. Startup is a rapid and increased growth of your sale. Then the consolidation secondary is a stage on the sale is your stable. Then slowly growth. Then your sale is decline, or we going toward to decline level, or we can say negative growth. Industry structure and performance, five determinants of a competition, threat of entry, revival between existing competitors, pressure from substitute product, bargaining power of buyer, and bargaining power of supplier. These are the five competition. Uh, these are the five determinants of competitions. So you must fulfill these requirements. Okay, thank you so much.